Today I'm going to talk about the housing market crash that just isn't going to come this time. I'll talk about reasons why it's different and why we're not going to see a big correction like we did in 2008. Stick around, I'll have some interesting content, and I hope you guys enjoy it. Good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Monday, October 23rd. I hope you all had a nice weekend. And today we're going to talk about the housing market crash that isn't going to come. Do me a favor before I get into it, before I forget, give a thumbs up, like, subscribe. I'm also going to put a couple links in the description on how to open an account at SoFi. If you put $10 in, you get a $25 bonus from SoFi. It also gives my son a little bit of a gift, which is really cool for me to see because he gets super excited about it. He's 12 years old, and I really appreciate the support. So why is it different this time, and why are we not going to have a crash like we did in 2008? Well, one thing in particular, which is called the option arm loan that they were using back then. I know there are a ton of guys on YouTube pointing to 1% down programs and things like that, but I'll explain the option arm in detail. And then when I finish that explanation towards the end, I'll start explaining why the 1% down and the other programs that these guys are pointing to are completely different and don't cause a market crash the way that the option arm did. So let's start with what is the option arm? The option arm is an adjustable rate mortgage, which is what ARM is the acronym for, that gave borrowers different options of what they could pick from in terms of making a payment. It would give them 4 different options that they could choose from. When they would get their bill every month, they had an option of a minimum payment, an interest-only payment, a 15-year amortized payment, or a 30-year amortized payment. And they could choose whatever payment they wanted. So the minimum payment was negatively amortized. What that means is each month they actually owed more money to the principal of the home that they bought. So if they chose the minimum payment to pay each month, which was significantly less than the 15-year and the 30-year option, and it was even less than interest only, they would continue to add principal to what they owed on their homes. If a person chose the interest-only payment, they were just making an interest payment on their mortgage. So they would have the same amount of money they owed on the house as time went on, and they would just make the interest payment. Differently with the 30-year option and the 15-year option, the 30-year option was what people traditionally think of a 30-year mortgage, and a 15-year option was what people think with a 15-year mortgage. If you made the 30-year payment, you were paying principal and interest, and your home would be paid off in 30 years. And if you were making the 15-year payment, which was the most expensive, your home would be paid off in 15 years. This is actually a very good loan that they no longer utilize because it got abused. It's really intended for investors. It wasn't intended to be sold to normal people just buying homes. And that was the underlying issue with it. The other thing is it matured in 5 years to where you could no longer do the minimum payment or the interest-only payment. These loans primarily began to get utilized in late 2001 and 2002, and all the way through 2004 and 2005, which was why we saw the housing collapse. People were able to get into very expensive homes with very low payments, but what they didn't understand about that mortgage was after the 5-year seasoning period, when you could no longer pick the minimum payment or the interest-only payment as an option on your payment, well, the minimum payment became maybe 4 times of what it was previously. And that was a big shock to people who really didn't understand the product they received. They were sold on things like housing only goes up. You could just refinance when it matures and get back into a lower payment, and all sorts of things by people who were selling the loan that really didn't understand it. Similar today, borrowing was cheap because of these loans, which is what pushed the prices up. That's similar. What's different is these loans changed over time. The loans today don't change like that. They were 30-year loans and 15-year loans at very low interest rates, but they don't have a seasoning period where the loan then changes and people get shocked by a new payment. Where back then, after the 5-year seasoning, you might have been able to buy a home around $1 million. And these are estimates, but I'm not that far off, for a minimum payment of $700 or $800 a month that would then mature into a $3,000 or $4,000 payment and really catch people off guard going, well, what happened to my loan? They were not happy with the new payments and they would look to sell their house. But there were so many of these loans that were sold that tons of homes came to the market. That is not the case today. That is why we are not going to see a collapse like we did last time. We're just not. It is possible that prices come down and prices on homes come down. They've gone up a good bit, but that's a bull run. And part of it, yes, is because interest rates were low and people were able to get into homes with low payments. The thing is, they're in those homes with 30-year normal mortgages that you and I think of, and there's no reason that they should be forced out of that home. They're not going to be shocked by a payment maturing and all of a sudden they owe 4 times the amount one year. It's just going to go up with natural property tax and insurance increases. So while we might see prices come down a little bit, which I don't really think we're going to see, you're not going to see any big, huge collapse because you're not going to have the sticker shock issue. That caused a banking crisis, which then caused huge unemployment, which caused thing after thing after thing to cause the houses to collapse. The other thing that changed is the banks realized they don't want all these properties. So you're not going to see the huge foreclosure rate. They'll come up with some sort of option, even if you did. And if you saw the Fed speak last week, where Powell discussed what was going on, while he expects unemployment to go up a little, he only expects it to go up a little. They're just not trying to crash the economy like people think. I understand there are tons of videos out there that sound wonderful, that point to all types of data, which are primarily the prices went up a lot and they think it's unaffordable. But I'll claim that unaffordable to who? And that's not really a reason that houses would collapse. Maybe they come off a little bit, which I've said a couple times, but really, the interest rates are reasonable. And even the new programs of 1% down, people need a job. They need to qualify with debt to income ratios. They actually limit those programs for the most part, is how you can qualify. What type of ratios you need are usually restricted. It's not as easy a loan to get into as people think. And unless the person who purchases the home using those programs runs into some problem where they are unemployed, there's no reason they shouldn't be able to make those payments and continue to own the home that they purchase. They still have to legitimately qualify. Back in 2002, 3, and 4, you had stated income and stated assets on top of the fact that these were interest only and minimum payment type of loans. So people didn't really qualify. If their credit scores were decent, all they did was say how much money they make and say how much they had in savings without anybody collecting any documents to prove otherwise. That's what caused the collapse last time. It was all the fraud that was going on. Towards the end, my wife and I went and looked at a home. And if I remember correctly, the price was around $450,000. Now, I was a commodities trader in Chicago. I had moved out to Las Vegas and I hadn't decided what I wanted to do yet, and I wasn't working. When we went to the new home builder's lot and the guy was talking us through and I was filling out the paperwork because we saw a house we liked, I wrote on there that I made, I don't know, maybe I put $2,000 or $3,000 a month. I didn't want to tell them how much I had in assets because I didn't really think that was any of their business. The loan officer was going through the paperwork, says, "Oh, no, 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 we can't do that," and crosses out what I had written and puts $10,000 a month. I don't remember what I'd written for the assets, but he does the same thing, and I think he gave me about $200,000 or $300,000 in assets. Well, we signed the paperwork. I put $3,000 down, and as we're driving home, I look at my wife and I go, this is ridiculous. I'm not even working right now. What happens if I don't pick up a job? I don't want to be stuck with that. By the time I got home, we called the builder and canceled the contract. And I even said, because I didn't know the rules, I do now, that if I lose my $3,000, that's okay. But I'm not comfortable buying this house with the process that was going on. So while I get that the loan officer did something wrong, the people that were signing paperwork and agreeing to what the person had said had to also recognize that they weren't being honest on the paperwork also. Well, the banks don't allow for that anymore. You're required to show documentation, prove income, prove assets, put down payments unless it's a 1% program, and things of that nature. So the people in the homes today, they qualified. And unless things change in their life, they still qualify. You will have the natural ebb and flow of people moving out of state, people moving or losing jobs, or things happening where, yes, you will have some foreclosures. Part of why they are upticking is prices have leveled off. You won't have foreclosures the past few years because prices went up so much. Why would there be a foreclosure? If your home went up in value, well, you just sell it. You don't foreclose. So I think a lot of these, as they're called crash pros, are missing some of the bigger picture as to why we're seeing the foreclosure rate tick up a little bit and why it's different this time. I will agree that it's become less affordable, but unfortunately for those who are continuing not to buy and continuing to rent, I think it's going to become harder and harder to qualify and less affordable in any form, whether that's because interest rates go higher or because prices do. I want to take the two scenarios that they're pointing to. So let's say inflation continues through the system and interest rates go higher and things on that line. Houses will be included in that. If inflation continues, there'll be inflation in home prices and homes as well. And if the Fed has to raise rates to slow it down, well, then the interest rates on mortgage will continue to go higher and your monthly payment would go higher. That is how that scenario would work. On the other end, if things settle down and the Fed is able to lower interest rates and cut rates, well, you will see interest rates go lower and the monthly payments go down for the same priced home, which I think will also push prices higher, making it less affordable. My real recommendation is don't buy too much. Don't push too hard that you're out of your realm of what's comfortable. But I sure wouldn't be continuing to rent and continuing to stay on the sideline and watching everybody else accumulate wealth and continue to save and grow their portfolios. I think the people who are continuing to rent, just like the history, will continue to fall behind everybody else who owns. Anyway, hopefully you like the content. Do me a favor again. If you've lasted this long, that's awesome. Thumbs up, like, subscribe, make some comments. Tell me why I'm wrong, what you guys see in the marketplace that says differently. I know this time of year, prices come down, but that's because we're headed into the holidays, and that, at least in Las Vegas, that's typically what happens. People get sidetracked with Thanksgiving and Christmas and even Halloween and New Year's, and they don't start looking for homes again until March or April, and that's when we see it start ticking up again. So I would expect to see some good deals this time of year, and I would hope people would be buying now before the end of the year and next year and prices start going up again. Anyway, have a good day.